Yeah, good afternoon, everyone. Our topic today is a very interesting one. It's titled The Role of Product Management in Designing FinTech Products That Drive Digital and Financial Inclusion. So that is more like moving from code to confidence and seeing the PM as the architect of inclusive finance. So today we are going to be focusing on the product manager. In the FinTech world, dedicated to male inclusion especially, the product manager is not just managing a feature set of the journey. They are the architect responsible for translating societal needs, such as access and literacy to finance, into functional, trustworthy digital products. They try to bridge the gap between complex technology and the world's most excluded populations. So the product manager literally has a key and fundamental role to play when it comes to driving digital and financial inclusion globally. And that is what we'll be diving into mainly. To sort of set the scene today, the agenda for today we run more of 4 key bullet points. The first one would be like setting the stage, and there we will try and define the dual inclusion gaps and some jargons that are associated with digital and financial inclusion. So we'll be explaining what the digital gaps and also the financial inclusion gap in this area, and of course, product management, what it means. And then that takes us nicely to the product manager's mandate. Product manager's mandate is talking about the inclusion first mindset. What is the role of the product manager in driving inclusion, especially when it comes to designing? And that talks about product strategy, which is the third bullet point, where we talk about designing for extremes, the technology, the challenges, the risks that are involved in making this happen. And from there, we'll go to the last point, which is the ethical responsibility of the product manager in addressing risks of designs and also providing responsible solutions that will ensure that whatever impact is being achieved, it remains sustainable and within the framework of regulations. So from there, we conclude and then summarize the key takeaways from the session. So, setting the stage. Product managers, for short, PMs. In case I use PMs, I might be using it a bit frequently throughout the session, just to know it's a short way of them saying product manager. So PMs must first understand the challenge they are tasked to solve, especially when it comes to closing the digital and financial inclusion gaps. Of course, we know as product managers, you cannot really solve a problem without understanding the root cause, without understanding analyzing the problem, who is involved, why are they involved, why is it even a problem, why is it an issue, why must we talk about addressing digital and financial inclusion gaps, what is the impact for those who are involved or who are caught in this web of digital and financial illiteracy or exclusion, and what positive impact will it create for them if they're able to access these services or able to be shifted into the financial mainstream through designs of product by the product manager. So this understanding is really needed for the product manager to get to the core of the issue and be able to efficiently provide solutions or design products that will meet the long-lasting needs of these individuals that are excluded and also close the gap. So in a nutshell, our PM's job is to solve for that gap, that overlap between the two gaps of digital and financial inclusion to ensure that fintech solutions that might be profiled in the process remains not just impactful, but sustained over a long period of time. So having set that tone, we want to look at the dual inclusion gap. That is the simple or short way of talking about digital and financial inclusion. We always say the dual inclusion gap. So the first bit of explanation or concept we're going to be defining and explaining is financial inclusion. Financial inclusion is simply defined as access to useful, affordable, and responsible financial services, which include savings, credit, payment, insurance, and so on and so forth. So you can see some words are bold there, which is useful. Like we say, It has to be relevant to the need of the customer. It has to be tailored to meet that problem that we're trying to address, not just what we think as product managers the customers might need. It has to be tested for purpose and ensure that it addresses the core fundamental needs of these underserved communities. That is where it is useful to them. Affordable has to talk about the cost implication on these excluded communities or individuals or populations, as the case may be. It has to be low because, of course, when we talk of exclusion, we are mainly looking at those who are of low income, who don't have much financial arsenal or resource at their disposal to carry day-to-day activities. So any product that's been designed and targeted to this group needs to really look at the cost implications. So it needs to be affordable. If it's not affordable, then the very idea of inclusion might not really be met. Then the next is responsible, meaning it has to be in a way that shows that we understand the very issues faced by these persons, designed not to exploit their vulnerability or their illiteracy in terms of digital or financial knowledge. It shouldn't be designed that way. If we say if it's a product is saying it's going to do something, you should do it, and the communication should be clear, easy to understand, free from ambiguity, and actually help to alleviate the problem or the poverty, as it were, instead of making customers second guess and then enter into more debt or financial problems due to the lack of responsibility in communicating the functions of the product. So that's what we mean by financial inclusion. These three key elements must be there in addition to sustainability over a long period of time. Now, the challenge for PMs is that the need to design product that actually really serves the unbanked and the underbanked profitably, safely, and affordably. So that is the key challenge for them. You understand? So the unbanked, like I explained in one of my sessions, some period ago, is those who don't have any form of interaction or access to formal financial institutions. They don't have any account. They don't have any business with any form of financial formal financial institution. Not at all. They do their things in the old informal ways. Maybe save money in their homes, in their rooms. They need to borrow money. They go and borrow from friends, family members, and so on. So nothing at all to do with institutions that offer financial support. So underbanked actually are those who do get access to some form of formal financial services, but still remain cut off from other financial services, formally, maybe due to their demography, or could be their financial capacity as a person, or somebody, maybe an immigrant, who, due to poor credit score or maybe lack of credit history in a new country, is not able to maybe get loans or mortgages, as the case may be. So that person might have an account who's running to do day-to-day transactions. In that sense, the person is partially banked, but because they can't get access to credit until they've lived in the country for a period of time and met some minimum threshold in terms of credit history, they can't maybe get things like loans or mortgages. So in that sense, they are underbanked, as it were. So the product, the PM has a real challenge here of designing product that serves these people along these divides, and then do so in a profitable way, in a safe way, and affordably. So the business, of course, has to be sustainable. So if the business is not profitable, they cannot continue to do what they do to meet customers' needs. So the issue here is, how do we design this product in a way that we as a business continue to remain profitable, and we also do this in a way that the risks involved in delivering this product is severely mitigated, such that the trust of the customers remains. Because if there are risks, maybe cyber risk or cyber threat or a data breach or whatever, in that sense, is no longer safe, and the very target population you're trying to seek to reach will not have that trust to carry on exploring that fintech product, and so will not be able to achieve that goal of financial inclusion. So that is a problem, or challenge rather, that the product manager is also faced with. And then how can they do this in a way that's also affordable to the customer? So a lot of thought goes into this, and you can see why we say the PM is the architect fintech solutions that drive financial inclusion. Then the next thing is digital inclusion. In digital inclusion, we talk about access to tools. So it has two sides to it. For digital inclusion, there should be access to tools, which are like devices, mobile phones, tablets, computers, and so on and so forth. That is access to tools. There are populations that lack access to tools. They can't even afford a mobile phone. They might have to go to a friend, to ask to use their phones, or go to a pay phone, as the case may be. So they don't have such access. So that is digital literacy in one sense. So access to tools like phones and all that. And then the next thing is internet as well. Do you have internet? You might have a phone, but you don't even have data. You don't have internet in your rural communities. So how do you tap into the opportunities presented by fintech products? So that is on the side of access to tools. Now, skills is another area. So one might have the tools, one might have the internet, but they lack digital skills or literacy to use those products efficiently and effectively for their own financial benefits as well. So these are the two areas for digital inclusion. So the challenge here for product managers is designing for extremes. So there is need for them to design their product in a way to capture the extreme. So if there are two divides, the right and the left, and on the left-hand side is the underserved communities, those that are financially excluded. The middle, we have the majority of people who are okay to use, who financial literacy is fine, digital literacy is fine, and all. And on the far end are those who are sophisticated, high-end users. So if we build for the extreme, usually the lower extremes, for those who are, let's say, the product is designed for low internet, for example, the product is designed to be used on feature phones. It doesn't have to be smartphones, the iPhones, the Samsungs. It can be just normal feature phone that doesn't even have internet ability, the ability to use internet. It doesn't have it, but the product can still work on such little device. That's the extreme on one side. So you are building for those who are not literate digitally, for those who might not have access to buy sophisticated devices, or smart devices that are expensive, and so on and so forth. So the idea is that once you're able to capture design a product that captures those at that lower end of the pyramid or scale, then there's a high probability that you've also been able to capture every other person on that side, on that scale, down to the middle and then to the end. So, but if we only design for those at the middle, so this is where majority of people are, they should be able to know it. The average user, as we call it, the average user. Then there are those who are not actually average users. It means we are excluding them, and they don't have that access. And that is a big challenge for product managers in terms of deciding, how to design these products to capture devices that are basic feature phones, poor or intermittent internet connectivity, and then low literacy level in terms of the user interface of the app and how it tries to communicate to customers. So that is on that side. Now we go to product management, some jargons there. One of the first thing is to define the very meaning of product manager. A product manager is the CEO of the product, and they're responsible for defining what to build, why, and for whom. This was what I said at the onset of the discussion today. So the CEO is the product. The product manager is the CEO of the product. So they define, the design, they look at it, okay, what do we build, given the demographic or given our target audience? Why are we building this, and for whom are we building this for? Once they have all those details, they can begin to tailor product that will help to see that this is achieved. The next concept or jargon in this discussion is the user journey. So this is normally, we hear it in product management, user journey. This has to do with the complete path that the customer takes when they interact with the product, or the business, and so on and so forth. So it begins right from when they sign up down to when the regular use of the product, to maybe when they even sign out of the product. So it is that journey. Like when I was working, one of the times when I was working as a product lead, product and business analyst, basically. So we were tasked with the responsibility of understanding why it's taking too long for customers to onboard. New members, it's a credit union really. So new members, when they try to onboard into the organization, from the point where they sign in on the website, indicate interest, filling the application, make initial deposits to set up the account and all, to when they eventually set up the account fully, for them to start using the services that by loans or whatever, it takes all about eight days. That is too long to sign up a business. So that was what I was charged with then, to understand what are the gaps, what are the pain points, at what point are those delays experienced. So we had to go through that process map with the team. I led that, we went through the process map, we designed it, we tried to know exactly what at every point of the journey, from the point where the customers open our website, they fill in their details, they send it. When they submit it, what happens next? It goes to the intermediaries, the payment providers, the platforms where we, interact in terms of payments or receiving of payments and all that. So we saw where the problem is coming from, and that has to do mainly with reconciling payments. From when they submit the payment, the processing of the payment, and before it gets to us, it takes all about 4 days just within that process. And then communication from us to those organizations, the payment provider, is always taking time as well. So that is where the key issue is. By the time we're able to fix that problem, we're able to bring it down from that 8 days to at least 3 days. It's not like it's the best of timing as well, but then it's far better, and that's almost 60% or thereabout cut off from the usual wait times that customer has to wait to sign up, and that has to do with a better user experience. So it's about looking at the product, and then looking at the journey. What are the pain points for customers, and how can we fix this so that their interactions with the product or the business continues to be a smooth and enjoyable one. Then the next thing is minimum viable product, MVP. This is more like the simplest version of a product that is released to gather early users' feedback and validate their assumptions. So that is what we do. We issue them out, we look at it. What do you think? More like a pilot phase. What do you feel about the product? Is it good for us to continue? What are your feedback? What are things we can improve on? Then all of those, we use them to continue to improve and develop the product as we go on. So that is one of the key roles of the product manager as well. And then the next thing is value proposition. For this one, we look at the promise of value that the product intends to deliver to the customer. So it's like you telling somebody why they should use the product. Why should you use my product? What competitive edge does it offer, different from other competitors in the market or other products in the market? These are my values I'm offering you. My device can do this, my product can do this and this, which you can get another place. My product can do this to this at even a cheaper rate than you can think of. Oh, mine is more expensive, I agree. But then look at the extra feature it offers you, which, given the impact of that feature and the extra little cost you're going to be paying compared to competitors, you find that it is worth much more than it. Something can even be more expensive and people still buy it. It all depends on the value proposition and what the customer perceive that they stand to gain, from that, for the use of that product. So this is a common concept that we hear often in the world of product management. So value proposition, some say USP, unique selling point, unique selling point, unique selling proposition, and so on and so forth. So this is it. I was tasked with somebody when I was doing an interview some years ago for a credit risk role, lending role. They were asking me if I feel I can sell the product. I told them, why won't I? I said, the question I told them is, if your product has a unique selling proposition and has value to sell that meets the needs of customers, then any product is sellable. As long as it has a unique value proposition to stand against competitors. And before I even sell any product as a person, the first thing I do is to look at the proposition it's offering. What is the value? I go to the competitors, I see what the competitors are doing, I look at exactly what is it that they have, and then I compare with the one someone is asking me to sell for them, and I see, oh, where is the unique point? Okay, this has this, this already has this. How does it weigh? How does it compare in terms of what the customer would like to hear? I put myself in the shoes of the customer. What is it that I would like to see in a product of this type, and that will really tickle my fancy to want to go ahead and sign up for it? So these are key considerations for the product manager. So that moves us nicely to the second part of our conversation on the agenda. That is product manager's mandate, the inclusion first mindset. So here we want to understand our inclusion focused fintech. For that to be achieved, the PM moves beyond standard business metrics to encompass social impact. So the shift here is, you're not just thinking about business, gains, profit. No. For you to actually design a product that is geared towards achieving digital and financial inclusion, the shift in mindset has to move from business gains, profit, KPIs to social impact. What impact is it making? How can I bring in more people who are underserved into the mainstream? How can we alleviate this problem for these people? So it moves beyond the money-making side of things to more of a social corporate responsibility. So that is what we corporate social responsibility in a sense, because it is like a journey you're trying to embark on that has purpose beyond just money making. So the goal is to maximize the utility of a product, that is how useful the product is, and then while also maximizing the trust of the customer. So the product remains useful and also fostering continuous trust from the customer. Remember, these are low-income earners. These are people of low digital literacy level, and they are always skeptical. They have their fears. They have their concerns with dealing with the big banks and fintech companies. Even a company that doesn't have an office where they can go and lay their complaints, it's just online. In most cases, they have their concerns as to why they should trust their little money. That money that you call little to them is like big. It's very huge because they know what they've gone through to get that little one. So they are only living from their own want. They're not living from their surplus. They're living from their want. So any dime, any penny, any naira, kobo that is lost is usually big to them. So that trust needs to be fostered. If it's not there, then the very purpose of trying to achieve financial inclusion or digital inclusion through fintech is defeated. So moving on now, we now look at the three pillars of inclusive product design rather. The first is affordability. In other words, the product must address the user's cost constraints. I think I said this when I was defining financial inclusion. So it has to address the user's cost constraints. So the PM's action here has to do with championing low fee or tiered fee structures, advocating for efficient, low-cost operational technology using cloud and so on. So the idea here is the customer wants to go for product that it can be tiered. You know what you call tiered transactions? Like when we go to bank, sometimes we have tiered accounts. So somebody who doesn't have even any ID card can still open an account. Somebody who has a school ID card can open an account. Somebody who has a work ID, just a business ID, work ID, can open an account. Somebody who now has the main full ID, like a proper national ID card or voter's card or international passport, can open an account. All of those accounts are tiered. They are different levels. The capabilities or features of those accounts are different for all of those customers. The transaction limits are different. The amount the accounts can hold, the amount they can hold, the limits on amounts that can be contained in those accounts are all different. And what they can do are all different depending on the level of KYC that was completed at the onboarding phase. So in the same sense too, the program manager can design products on these tiered fee structures, such that maybe one can say, oh, we're going to design this app. If a customer wants to make microtransactions, for example, micropayments, they don't get charged. Sometimes when you make, say, 50,000 naira, you might be charged, I don't know, less than in Nigeria, probably 30 naira, for example, for 50,000 naira. Then as you go higher, you might go higher as well with other service fees that goes later on at the end of the month. So for a product that's been designed to meet the financial inclusion need in terms of affordability, these can be reduced. They can put a minimum amount. Okay, for someone making micro transactions of, say, 50,000 naira or maybe 20 pounds, there will be no fees, no transaction fees, to be free. That way, you are encouraging them to come into the financial mainstream. I mean, those who are underserved communities, you're encouraging them to come in. But when we keep charging for everything, it doesn't matter whether you are rich, whether you are poor, whether you are student or not, then it doesn't capture this community. So that can be an incentive to bring these people into the financial mainstream. Then the next thing is accessibility. The product must work for the widest possible audience. The product must work for the widest possible audience. What this means is that the PM's duty has to do with mandating the support for, say, USSD service, USSD kind of feature or non-internet enabled product or services, as it were. So the basic feature phones can be able to carry out transactions along with normal smartphone applications. So we talked about this earlier too. When you have like feature phones that doesn't have internet connectivity or internet capabilities, the normal small phones, you know, just press and that is it. When you use the USSD unstructured service dialing code, maybe dial star to make payments, maybe dial star 123 hash, and then you dial it, and then it brings up a list of you know, banks or whatever the case may be, your amount. You just keep dialing codes, just like you're trying to make a call, and then it's taking you, okay, press 1 for this, press 2 for this, press 2 for maybe payment, press to check balance, press 2 to transfer money, press 2 to buy airtime or data, or and just like that. So numbers for each action is easy for those who are excluded. So even if they don't have the money to buy smartphones or expensive devices like that, they can, even with their little basic feature phones, they can still use the USSD codes to make basic transaction, and that has to do with accessibility. So even those in the farmers, the rural areas, everybody can be able to, you know, enter the mainstream, and that kind of makes it easy to capture the widest possible audience. That goes along with designing for extremes. So if a product can capture these people at the lower end of the pyramid, who can only afford feature phones without even internet, because those feature phones don't even have internet access. So it's not a function of internet, no internet, just basic feature phones for normal calls, and they can still use that phone to make microtransactions, as it were, recharge airtime, and so on and so forth. Then invariably they are being you know, encouraged or incentivized to come into the financial mainstream and leave that exclusion group. So the third one is usability or simplicity of use, if you like. So the product must be easy to understand, even for low literacy users. So the product manager's action here would be to focus on intuitive, visual-based user interface, minimizing text and using local languages and audio cues. So even if they want to use apps or internet to access finance, these customers, the design of that app should be such that it doesn't consume too much data. It should be designed. They can even have two versions. I mean, the program manager, you can have two versions, one for the high-end users and one for these customers who are digitally excluded or financially excluded. So that one, even if you have, just like we have Facebook, for example, we have Facebook, the normal Facebook that is, you know, data that consumes data, and we have Facebook Lite, which even with the lowest of data, you can still send messages and do stuff. That is Facebook or Meta trying to be inclusive in that sense. So by having two versions of the app, one for those who are able to have internet, or, you know, who are comfortable at the right-hand end or the far end of the pyramid, or the top of the pyramid rather, those at the lower extreme can at least still be able to do things with low data consumption if they must use the internet. And then there's some also products that are designed, is easy to use, it's simple, no heavy languages, no too much letters or something. The buttons are big and, you know, large enough to use. It's clear and simply stated. There's no complicated English or large grammatical concept in there. It's just straight to the point with clear buttons directing them on what to do. And in some cases, there are audio options that some will tell you, even some apps or USSD code will tell you if you want to, or if you want to listen or carry transactions out in your local language, select maybe button 1, English button 1, maybe Igbo button 2, Hausa button 3, Yoruba button 4, Pidgin button 5, and so on and so forth. So these are ways. So whenever you select, it comes in a language that you're able to comprehend. That is inclusion as well in that design. So this is what product managers do to ensure that everyone is brought into that financial mainstream. So these three pillars of inclusive product design is critical if digital and financial inclusion goals has to be achieved, and that gap needs to be closed. Affordability, accessibility, and then usability. Then we go to product strategy. The third part of our discussion, product strategy. We are talking about designing for extremes. Again, a successful inclusive fintech product strategy focuses on overcoming the unique constraint faced by excluded population. Now, when we talk about excluded population, it's not only just those who are really wouldn't go, maybe who are poor, who are low income. As you can see from the picture there, people with disabilities who cannot really, say, go to a bank physically, they are also in a way at the risk of being financially excluded or maybe digitally excluded for one reason or the other. Then those who are getting older, the older population, these ones are not tech savvy. They might not be able to move along with the ever and constantly evolving trends of digital technology as we have them today. These ones too are people who might fall in these extremes. We talk about the average users, as you can see, this is where majority of people might fall into. And then designing products for these people at the average, at the middle point, may cut off those at the left-hand side, especially. Then we go right-hand side, we see people under stress. It could be stress from work, it could be stress from family, it could be stress from the loss of a loved one, and the process of maybe the burial. It could be stress from maybe health. Maybe they were just diagnosed with a very chronic illness, maybe cancer or kidney problem or something, and it's just messing up with their mind. So these are things. It could be someone who is even going through the process of divorce, and it's causing a lot of mental pressure for such one due to the emotional, issues that goes along with all of that. So these are people too who want to also consider in this context. And then mobile power users, these are those who are very efficient and very, very okay with using both financially, they're included, digitally they are also good to go. So this is just what more like it looks like when we talk about designing for the extremes. So now I want to talk about leveraging technology. How? So the first concept here will be more on cloud computing, how product managers can leverage technology to be able to achieve the goal of financial and digital inclusion, and see that they're also closing that dual inclusion gap. So cloud computing, this is applied for the PM in the sense that it allows for low cost, secure, and highly scalable back-end infrastructure. So what does it do in terms of impact? It impacts affordability, because here overhead costs are dramatically reduced compared to traditional banking servers. So what we're talking about in a nutshell here is the use of cloud computing helps in the storage of data in a secure, efficient, and even cheaper way. So if we go to most banks, as we used to know them, traditional banks, we usually have a large server room where they have all their computers, their systems, application, everything is just there. It costs a lot of money to have those assets in that very IT room, as we call them. It costs a lot of money, and also it costs a lot of space. It takes space, and there is high risk that once there's a breach in that system there, the business might not continue. That business will not be agile. If there's anything like COVID-19, for example, and all the system servers localized in one room, people cannot go to office. That means nobody is there to say turn on the IT server for people to be able to log in, and start doing their job, and customers are able to also enjoy benefit they want to enjoy wherever they are. So having that localized kind of data infrastructure, or as it were, kind of costs more money, because there are staff will be paid for that, of course. There will be IT team, and it's not just one person. You might have software developer, you might have the back end operators and the data analysts. All of them might just be there, the engineers and all. So you pay them every year. That is more cost, apart from even the infrastructure itself. And then when it goes bad, you have to pay, and then you have to do maintenance as well, and so on and so forth. But when you have all of those data, you sign up for a cloud computing service. It's far cheaper. It's in the cloud. Your business is more agile and scalable, and then the costs on the server is also felt, because now the business can easily, when there's even need for business continuity plans, say there is an abrupt change in business due to maybe a pandemic or a disaster that happened, people can log in from their homes and work, because they have a cloud. Their whole data and their ability to access the systems is not localized in the office, it's in the cloud, and so can carry on their business efficiently without any much hindrances or disruption in the way they operate. So with this service as well, they can now cut down costs, costs that have been used to pay all of those operational costs for having that infrastructure, IT infrastructure in a building, the physical building, and then paying staff and all that. They can cut it and then reduce the cost of delivering services and making it affordable for the underserved communities. The next thing is about artificial intelligence and machine learning. For the product manager, this is applied in the area of credit scoring and digital lending that are based on non-traditional data, like phone usage, utility bills, and digital footprint. So Leveraging AI. AI is an evolving field today, and machine learning, where codes are designed, algorithms are designed to be able to predict customers' behavior, customers' interaction with the business, customers' likelihood to take up a product or a lending product, as it were, has really, really helped to deepen financial inclusion. People can even access loans from the comfort of their homes. They don't have to go to the bank. They don't have to meet all the very difficult conditions required to access credit or loans, as it were, from traditional banks. So by using maybe alternative data, and then configuring them in this way, the product manager can design fintech products that will help to use data such as we see on the screen, phone usage. They can use it. Okay, how is it your phone? How much is it? How much data is it buying every day or every week, as the case may be? Do they owe phone providers, or do they pay promptly if they take up any service for credit? Do they the utility bills? How do they pay their light, the energy, the gas? How do they pay for all of this? Phone bills. How do they pay? Do they owe? How do they owe, or do they pay promptly as they should pay? And is it regular? Do they have a regular payment method? So that is all the profile that is being taken into account. Your rent, how do you pay your rent? Do they pay regularly? Shopping and all that. So they look at all of that, and then they create a credit profile, as it were, using those AI and machine learning algorithms to now determine, okay, based on this, we can determine this person can take so and so amount of loan. Let us at least give them this for a start and see how it goes. And that solves the big problem of credit exclusion, because granting credit access to those without formal credit history by leveraging what we call alternative data. So that's one of the ways product managers can leverage technology to close that dual inclusion gap that we're talking about. The next is data analytics. So here we're talking about monitoring transaction data, successful failed user journeys, and dropout points. So we look at the trends. What does the data tell us? We have customers, they are coming in. Oh, what is the dropout rate? How many people are taking up our product? What is the experience? Oh, those who drop out, what is the reason why they are dropping out? Can we go back to the drawing board and understand why? Are they from any particular demographic who are dropping out more? Could it be those who are older? Could it be those who tend to be from a different country? Probably they don't understand English. Could it be more of women? Could it be more of men? Could it be more of married people? Or what? So these are trying to be as inclusive as possible. Well, let's know. Could it be that these are the issues why they are dropping out? Or who are those that are taking up the product more? Could it be more men? Could it be more of a younger population? Could it be more of those who are literate? Those who have maybe a BSc degree and upwards. Are they more of our customers? Or what about those who maybe didn't even have a school certificate, a high school certificate? What is the spread of these people? Are they even really here? What are the occupation of people taking up the product? Do we have more of those who are on the white collar jobs? What about those who are in rural settings, the low market traders, the farmers, and so on and so forth? What is their spread in all of this? So by looking at all of those data, the product manager is able to understand the transaction and monitor it and understand where it needs to be addressed and how they can improve their inclusion strategy and the social impact on the underserved communities. It's not just about profit, like we said. It's not about the business. The business can be profitable, but a business that's geared or really interested in closing that financial and digital inclusion gap will want to look beyond the bank account and profit being made to exactly the impact they're making to close those gaps. And this ties in nicely with the area of usability, allowing project managers to quickly identify where users are confused or dropping out of the process. For example, KYC, that's complex, like I hinted earlier in my example of the onboarding for those who are trying to join the organization where I worked with before. So moving on from there, we're looking at overcoming challenges and obstacles. So what is the product challenge for product managers in designing and achieving these goals? First one is a poor connectivity. Poor connectivity is a challenge. The strategy to solve this problem could be to design the app to be offline first or low bandwidth, caching data locally and syncing only when connectivity is detected. Here we are simply talking about when the app is designed to be offline first, meaning those who are in rural communities who don't have access to internet, they can still do transactions just like USSD. It doesn't need internet. So when they say they want to send money or check their balance, as it were, they can do that offline. Now, or we talk about low bandwidth, where the data needed, the user interface of the app is designed such that it only consumes very low data, like in the case of the Facebook Live we talked about, very low data, so that it doesn't cost them much. So the idea of the offline test is such that they can do transactions. It will go through, let's say they send 10,000 naira or maybe 20 pounds. It will go through from the customer's end, even without internet. But it is now cached somewhere locally in their device in an encrypted form. But for the customer's point of view, they've made the payment. Though it has not been sent to the bank because there is no internet, but it is cached somewhere or stored somewhere locally within the device in an encrypted format in the phone. So once the customer manages to get internet or happens to be in the place there's internet, all of those pending transactions, could be 5% of them, they'll all be queued to just move straight to the bank, and then the bank can now reconcile of that in real time. Or if it's an agent they are using in their community, that can also be the same case. So in this way, a customer doesn't necessarily have to wait for internet for them to transact, because they might not have the money to even buy data to use the internet. So if you say there must be internet before they do transactions, then they will be discouraged to even do it, because they don't want anything that will make them spending much money when they are not ready to spend such kind of money on data. So that is the idea of offline first. So this helps to prevent that problem. It has its own risks. It has its own risks, to be fair. But then how product managers trying to address the risk is maybe to minimize amount that can be sent when there's no internet, right? So they can put a limit. So maybe you can send more than 50,000 naira, as the case may be, when there's no internet. So once you've maxed that one out, you have to wait for internet to proceed. It also helps to prevent fraud, or even double spending, because sometimes when they spend the money, it's not reconciled. It might be showing they will go to agent and spend again. Because of that time lag or window in reconciling or synchronizing the data between customer, the agent, or the bank, they might have double spending issues, where someone is even spending money, doesn't even have his account, because it does not be reconciled. So these are some of the issues. But then there are designs made by the program manager to ensure that these are mitigated, as the case may be. Then the next challenge is security risks, social engineering. So here we're talking about the solution, which is integrating digital literacy education directly into the user journey, using simple non-technical warnings, such as we will never call you for your PIN or password. So we understand that customers can be socially engineered. These people are not literate, they're not digitally savvy. So the risk that they can be engineered by fraudsters and scammers is very high. One can just call them and say, madam, your account is about to be blocked, or your account is about to be blocked. And can you please, I sent you a code now in your phone. Call back that code for me so I can use it to recover your account so you don't lose money. Of course, they don't want to lose their money, and in that vulnerable state, they'll comply with whatever has been said to them. And then when they provide that, the scammer can easily use that to, hack into their account and take away all they've ever worked for. And that can even plunge them into furthermore poverty and exclusion. So the very purpose that the program manager is trying to achieve with that fintech product of including them would be lost. And they can even spread that to all their friends and all their friends too, who is even planning to, or who has even joined, might even say they're not doing it again. They'll just leave that system or that fintech app and continue with their normal lifestyle, and then it's now a loss for everyone. So there has to be constant education, literacy, text messages, adverts on TV, radios, to educate people about digital literacy. So oftentimes customer banks or fintech companies send text messages to their customer, like the one on the screen, that we will never call you for your PIN or password. So that is a simple message, letting them know that if anybody calls you for that, please don't do that. Hang up the phone and give the bank a call to verify. Don't be tempted to do that under any guise. So this is an example, and that way that can be at least mitigated to a reasonable extent. The next challenge is KYC verification. That is know your customer. That is KYC. Here, the solution we are looking at will be to integrate emerging digital identity solutions. For example, National Biometric Database, to replace paper-heavy in-person verification requirements. So there are apps that are designed, or even structures that are designed to ensure that digital identity is done in a tech manner and is encrypted in a way to ensure that the database is secure and even housed within the national framework or infrastructure. So having customers to have this kind of ID system will even be a biometric like fingerprint, as a way of doing the KYC. Fingerprint, Face ID, things like this can help to secure the KYC, because these are all unique identification features that people, no two persons can have at the same time. So that's how to do that instead of using paper all the time to verify customers, which these people might not even have that literacy really to go through. But they have their fingers all the time. They don't need to memorize anything. They can easily do. Their face is always there. They can do that. So these are some ways that program managers can overcome some of these obstacles that comes with designing products for extremes, to include financial and digital inclusion as well. So the fourth part of our conversation today will be the ethical product manager. We are looking at the risks and responsible solutions. So here we want to establish that driving inclusion ethically requires that product managers manage the trade-offs between business goal and social impact. We've mentioned this before. It is always managing that trade-off, the fine line between business goals, profits, and then the impact we're trying to make in the lives of the underserved communities. So moving on from there, we look at these key risks. What are some of the key risks that need to be managed? So the first one there is data privacy and bias. So machine learning models, if they are not trained properly, they are trained on skewed data that is maybe looking at only one segment more of a demographic spread. They're only focusing on maybe more of people who went to school, or people who are doing high income jobs, or people who are white collar, whatever it is. The data is not looking at a fairly evenly spread of everyone at all extremes. Then whatever the model is giving, whatever results that machine learning model or algorithms is giving will be skewed to unfairly disenfranchise those who are financially excluded. It could end up leading to denying of credit to a specific group of people, and then even exacerbating or enlarging or broadening that gap even further. So when these algorithms are designed, it is imperative that product managers or data analysts and scientists look at ensuring that there is an even spread of this. Like you can have some app whereby they might tell you once to look at when you want to enter a building, if you put your face, to scan your face and then you go in. But in some of those buildings, we see that that design was only done with more of people of, say, British or European, descent. So when somebody from Africa maybe comes and put their face, because the whole AI feature wasn't designed to capture this kind of face, probably because they were not expecting people of that demographic to come in or in such numbers or at any time soon, it will reject that person, and then that person might not be able to access the building because of that. And that is the bias we're talking about already. So it has to capture, when we're talking about this product, it must capture the machine learning model must be trained on data that is evenly spread and a good representative of the target population. The trade-off here will be the speed and scale versus fairness and accuracy. So in as much as they want to roll out product as quickly as possible and then grow the business as quickly as possible, target people who will give them more income, they want to balance that with fairness and then accuracy of data. And that's the dilemma for the PM. And that is ethics. We're talking about ethics. So anything that is biased is going against a lot of ethics. So that is why it's important we discuss this when it comes to designing product. Then consumer over-indebtedness. This is another risk. So product like instant digital credits or buy now, pay later, BNPL, can lead to debt spirals for financially unsophisticated users. So the point here is there are products that can be designed by product managers in a bid to grant access, to grant credit to the financially excluded, which is a good thing. There has to be a balance, because if it is abused, it can plunge these people into even further debt and financial difficulty, because there is no boundaries, no measures put in place to control how they access credit. If you go to Nigeria, for example, there are some people who take loan from different, loan lending apps, all at the same time. They just keep lending and they owe all of them because they don't have money to pay. Or some don't even have understanding of how to manage finances. They just want to access money. They hear people are collecting money in this place. They go. It's like free money to them, but it's indebting them. And even if they have any credit score, it will make it worse, because those might be reported in some cases to the credit bureau agencies, and that will make it even difficult for them to access credit in the future. So that can place them in more difficulty as you may think. And then even like in the UK, for example, there's some apps that are designed to restrict gambling. Some people, they just gamble at will. They just gamble at will, and the more they gamble, they lose money. At the point they don't even want to even eat because they're just addicted to gambling. Or some apps are there that put some restrictions on how much you can use to gamble or how often you can gamble. You can even set up your app in a way that the customer can try to lock gambling. So if I spend up to this amount, don't allow me spend any more on gambling or whatever. So these are some measures some products put into their apps, for fintech products like Monzo, to prevent such impulsive spending on, further credit debt. So the trade-off here will be conversion and growth versus financial health. So while you're trying to convert people to bring in these excluded people, so you can be growing, your number is increasing. You want to balance it with their financial health. That is the social impact we're talking about. Think about the impact on their social lives, not just the profit side of things, the volume of customers, the volume of income being, achieved or gathered. No, it has to be a balance. The next one is fragmented trust. If the product fails due to cyber attack or poor service, then users may revert to cash or informal finance, harming the inclusion effort industry-wide. I think I hinted this earlier in terms of trust. So if a product fails due to phishing, maybe social engineering or cyber attack, these funds, customers lose them. These low-income earners, these disabled customers, these low digital literacy customers who are only struggling, and then they lose their funds due to some form of fraud, scam, cyber attack, or whatever. The next thing is that their trust will be broken completely in the system. It will be broken in the product. They don't want the product anymore. The inclusion drive will just die because they will just terminate their relationship with the former financial system. They will leave and go back to the way they do things through cash, informal way of financing, and maybe thrift collecting, their jaws, their friend borrow me, rotatory savings, we do as a group. This month you collect, this month I collect. They'll just keep doing their business like that and leave the banks. And then that inclusion aim will not be defeated. So the aim here is for the product manager, the trade-off here is to determine the time to market versus security by design. Security by design is simply talking about designing simple products that are transparent and also resilient, that can withstand any cyber threat or shock at any point in time. So these are some of the key risks that can emerge for product managers when it comes to designing products that are geared towards closing the digital and financial inclusion gap, and also some ethical consideration that they can look at in terms of trade-offs and to manage all of these risks. So we now move on to nearly the end of the session now. Recommendations for responsible product management. So here we have about 4 recommendations. The first one will be security by design mandate. Here the product manager must ensure security is non-negotiable. It's not a patch. It's not something you just put. Okay, let's just put it. It has to be an integral part of the product design. This means that the mandating of high standards, use of encryption, authentication, even for low-end devices. So there has to be thorough security being considered in the design. The next one will be focus on financial health metrics. PM should track metrics like repeated loan defaults, customers' debt to income ratios. Before they try to advance loans, they want to check the health of customers. How much have they defaulted, and what's the chance that they're going to pay this loan we're going to give them? If they give them this loan, we plunge them into more difficulty, we mess up their credit history even further, and their chances of even getting more loan in the future will be completely, obliterated. It will be gone. So we want to weigh it. How much loan do they have so far? How much are they earning? And what is the balance left to take this new loan they are taking and still pay comfortably without stress? These are considerations that has to be done. And then we want to look at the impact. The success of the product means improving the user's financial life, and not just extracting value from them. We also want to improve their financial lives. The third point here is to implement cool-off periods. So for high-risk products, like maybe instant credits, the product manager can design, can put in some friction, like some window period, where they will not be able to access the credit or do some transaction, just in case they have any impulse that they have at the moment. That impulse will die after that hour. Maybe putting like 12 hours wait for them before they get their first loan disbursement. So if they are thinking that once I get this loan, once I send this, I'm going to get this loan now, and I'm going to just go and buy this, buy that, go on a shopping spree or go on gambling. Once you put out 12 hours, that desire might die down and they might start seeing things fresh, in a fresh perspective. There might be more pressing need that will come up that they will use that money for, instead of that impulsive spend they want to go and involve in. And that will help to mitigate that detrimental decision on the part of the customer. So that is talking about implementing cool-off period. And then the fourth one would be to embrace regulatory sandboxes, where project managers should utilize control testing environment, where they can test the environment before they launch the product. You know, it can be complex with some customers, live customers. They will not be held under regulatory requirement, as it were. It will be there for them to test, pilot it, see that it's all working fine before they now launch it to customers. That will ensure that there is consumer protection, you know, and then that the product actually is designed to fit for purpose and the regulatory requirements. So that is that. So in the conclusion now, we want to understand again, reemphasize that the PM is the architect of inclusion. The program manager is the architect of digital and financial inclusion, and they serve as the critical link between innovative fintech and genuine social impact. So the core PM responsibilities in a nutshell from what we've discussed so far today, and the key takeaways is that one, the PM needs to define success by impact. So they need to measure not just active users, not just the income they're making, not just the volume of value they're getting from the business, but also sustained economic activity. How frequently, how long are these people using this over a period of time? How is it meeting the needs of this excluded group? And then their improved financial health, without plunging them into even further financial difficulties due to the way the product was designed. The second point would be designing for the edge case. Here, the PM is building for the user with the oldest phone and the lowest literacy, and everyone else would benefit. That is what we meant by designing for extremes. So the PM builds for the users who have the oldest phone, the feature phones, the lower end phones, and then the literacy level is also the lowest. Once you build for that target population, it can also make an inference that definitely that product is also designed to fit in with every other person else, because you've captured the very lower end of that pyramid. Then the third thing would be to prioritize trust. So we want to recognize that trust built through security and responsible design is the most valuable currency for the long-term success of fintech and global inclusion. Trust is paramount. Without trust, any financial inclusion goal you are doing to capture those at the lower end, the underserved communities, will fail because they work on trust. Fintech without trust, or financial inclusion without trust, is equal to nothing. What will be achieved? It will be highly defeated. So they want to prioritize trust in the way they design their product, making sure that the product is designed to fit with security features. And that would be the biggest currency for them, because it will ensure continued and sustained long-term success in the fintech product design and in also achieving global financial and digital inclusion. Thank you very much for your time and for your audience. I really appreciate you. I hope that the session today has been able to highlight and show more insight on the role of the product manager in designing fintech products that drive fintech and that drive digital and financial inclusion. Thank you.